Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day and spending it with us. I think we have a great show today with some really timely topics that I've spoken to many of you about. A lot of topics that my individual investors, my clients have talked to me about. I've been going around meeting a number of individual investors, and a lot of the questions that they've had, we try to put them together and make a list, and we try to bring some answers, some clarity to all of you regarding those topics. So some of the topics that we're going to be touching on today are 2023 has brought a shift in investors' sentiment. What does that mean? Coming out of 2022, December was a very weak month. Did the average investor change the way they thought about 2023? I think they have. We're going to touch on our usual topic, which is the This Week segment, where we talk about what I believe is important for individual investors to consider before you make your investment decisions. Timing the markets. I think January, the good start to 2023 really shows us that you can never time these markets. And if you're foolish enough to try, you always seem to end up on the wrong side of things. So we'll speak about timing the markets and why January gives us another example of why you can't be timing markets today. AI, artificial intelligence, and ChatGPT. Terminology that we've heard a lot about in the last few weeks. We'll touch a bit about that. We'll touch on that a little bit. We'll talk a bit about Microsoft and Alphabet, formerly known as Google, what they're doing right now to use artificial intelligence with their search. We're going to touch on oil once again, the price of oil. Is oil a good investment idea currently? Price of oil now is somewhere around $75 a barrel. Can we buy oil today? And what would be looking for when we buy oil? What types of oil stocks should we be looking at? Our second last topic, RSP versus TFSA. As we all know, the deadline for RSPs is 1 week today. So anyone who's looking to get your RSP contribution in for the 2022 tax season to be eligible to write off that RSP contribution for the 2022 tax season, that's March 1st, and that's 1 week today. And lastly, your questions. Please feel free to ask me any question you like during the broadcast. I'd be more than happy to discuss any questions that you may have regarding anything, your individual portfolio, or anything in the markets, what you're seeing or reading online. So without further ado, let's get on with the first topic. So 2023, in my opinion, has brought on, a sentiment shift for the average investor. Normally, December of any year is a positive month. Like I always tell my investors or many individual investors out there, November, December tend to be the best months out of the year for investment or to see the markets move higher. Well, December 2022 was actually a very poor month. One of the few Decembers that we've seen in a long time that didn't really produce the returns we were looking for. We got a bit of a Santa Claus rally at the end of the month and early into January, but overall, the month of December was a weak month for investors' returns. So coming into this year, individual investors were nervous, were scared, thinking about how many more rate hikes can the Federal Reserve and Bank of Canada make. Investor sentiment overall was quite poor. However, turn the clock to 2023, and all of a sudden, things started to move higher, catching a lot of individual investors by surprise. So this investor sentiment, this shift, why did it happen? When you look at it, and here we have the U.S. 10-year Treasury rate, we can show that here of 3.95%. The last time we saw the 10-year rate this high, so interest rate of the 10-year close to 4%, the S&P 500 of the stock market in general in the U.S. was several hundred points lower. So why was the average investor able to withstand this higher interest rate this time and still have the market move higher for the month of January? Take a look at the 2-year government bond rate in the US. And you could see that it actually peaked out or has reached recently a high of well over 4.5%. The 2-year Treasury in the US, last time we saw this high, again, the S&P 500 was a few hundred points below where it is today. So it just seems like the average investor has been able to swallow or take into consideration these higher rates, factor them in, and still move higher. The stock market for many individual investors overall in general was up about 5 to 10% for the month of January. I saw some individual portfolios up maybe as high as 10 to 15% in a 5-week period to start the year. And I think it was because individual investors have been able to factor in these rate hikes. They're basically considering or thinking that there may be only 1, maybe 3 at the most rate hikes to go. We've already seen one at the beginning of February, maybe another 2 more to go before the Federal Reserve hits their target. Here, the Bank of Canada in Canada said that they're going to put a pause on interest rate increases for the time being to see how things play out. And so far, so good. We've seen inflation pull back. So overall, I think individual investors have been able to factor in higher rates, this idea of higher for longer. And I think this is why markets have moved higher. So overall, this idea of, why investors have been able to continue to buy this market early on in 2023, I think it's just because we've been able to factor in higher rates to come, maybe just a few more interest rate increases. But more importantly, we're able to say, well, this is where we are today. Doesn't seem to be getting much worse. It can only really move higher from here. And I think individual investors just started to buy the things that fell the most last year. And we saw it in the month of January. And hopefully it can continue over the course of 2023. Now we enter into the part of the show where I discuss what I believe is important for individual investors, all of you, to consider before you make your investment decisions over the next few weeks. Here you can see we have 3 topics, as we always do. The first topic, central banks and inflation, seems to be always the number one topic, right? Listening for what central banks are going to say about their fight against inflation, especially the Federal Reserve. What are Fed officials, Fed governors saying? The second idea that I think individual investors need to focus on continues to be quarterly earnings. Quarterly earnings season most of it is behind us now. We still have the odd earnings report. Tonight, NVIDIA comes out, one of the largest chip makers in the world in the US. Their earnings will be key to the tech space tomorrow. But overall, quarterly earnings this past week, I think the important area has been retail. We heard from the likes of Walmart and Home Depot. What are they saying? And what can we glean from what they're saying with respect to the overall economy? And lastly, taking profits. Yes, I'm not saying that the stock market will not and cannot continue to go higher. But I think with the start of the year that we've had, plus some of these investment ideas that we've been speaking about over the past few months, I think there are some profits there that individual investors can be taking off the table. Maybe not selling all of the investment, but maybe just trimming some of the gains. So taking profit is something I think you need to consider. So let's start with central banks and inflation. Overall, I think we have actually a great chart which shows Canadian inflation and core inflation. The 12-month chart here will show you that inflation is coming down. The overnight rate now is 5.9. Well, the overall inflation rate now is 5.9%. And you can see that the Bank of Canada rate is actually getting higher. And you can see those 2 lines kind of coming together. And that's a good thing. When those lines actually meet, many people think that the Bank of Canada and the US Federal Reserve will stop raising rates. So we're seeing that here in Canada with our rate now under 6%. Inflation rate just came out under 6%. And it looks like we're at a 4.5% current overnight rate with the Bank of Canada, getting closer and closer. In the US, the Fed has continued to say that they're going to continue to raise interest rates. We've heard from some bank governors in the last week or two, and they're talking about seeing a terminal rate or final destination for rates above 5%. And this was something that we really hadn't heard before. We were anticipating originally maybe 4%, started to move higher to 4.5%, 5%. And now, most recently, Governor Bullard, the head of the St. Louis Fed, was on TV early this morning, and he talked about a Fed funds rate of about 5.4%, 5.3% in that range, the highest that we've ever heard it. So overall, I think you could see another couple of rate hikes between now and then. I also believe that the most recent pullback in the markets has happened over the last week, week and a half, because Fed officials have now taken up their expectations for higher rates above 5%. So once again, before you make your investment decisions, have a listen to what these Fed officials are saying. Where are they saying rates will end up? And I think from there, you can understand or factor that into your investment decisions. Factor that into how the market is going to behave and what types of investments do you want to make. Interest rate sensitive investments versus non-interest rate sensitive investments. Will banks win out, or do you want to keep buying technology? So understanding where central banks or what central banks are saying and where they believe interest rates will top out is key before you make your investment decisions over the next few weeks and even months ahead. The second topic that I think individual investors need to focus on, as I mentioned, is quarterly earnings. And we received two big ones this week. And these are basically two of the biggest retailers in the world, and definitely in North America, and that is Walmart and Home Depot. And we have a few charts showing first Walmart. We can pull that chart up. Now, Walmart had fantastic earnings. They beat on the top line growth and the bottom line growth once they factor in expenses. They spoke a bit about how wages have gone up. They try and attract new workers and to keep their existing workers. But overall, their earnings were actually pretty good, in my opinion. Stock sold off initially, but then rallied to end the day on a positive note. Walmart has said that they believe going forward, things are going to continue to slow. They're seeing their grocery business do very, very well, which is, I believe, one of the main reasons why their earnings were so good. But on other items, maybe higher margin items like electronics, for example, not seeing the growth there. They're predicting or anticipating the consumer to slow down the spending. So I think that initially caused the shares of Walmart to fall. But then once people really started to focus on how good Walmart is doing, stock really ran from there. Home Depot, which we have a chart of as well, they weren't as good. Earnings, I thought, were good, but not good enough. They spoke about increasing, again, wages, which really ate into their profitability. You look at their stock in and around $297 today. That stock was about $330 not too long ago. We're talking maybe a few weeks. And you can see the chart here. It starts to tail off when you get to the far right of the chart. But as you can see, well above 320 at a bit of a peak there not too long ago. And once again, the CEO of Home Depot has said that going forward, they see a slowdown. The consumer will slow down their spending. A lot of what many CEOs are talking about now is the average consumer or the average person spending on services versus goods. And we continue to see that. And that's probably why services or inflation in the services area has been stubbornly high, whereas pricing of goods has come down. So going forward, let's keep an eye on more quarterly earnings. I know Target reports next week, another major US retailer. Let's see what they have to say. Obviously, slightly different than Walmart, very different business than Home Depot, but we need to focus on the remaining big companies that are going to report earnings. I mentioned another one in a different area of the market, NVIDIA. We'll see what they say about their chips. And as we know, their chips are used to power artificial intelligence. The third topic I think individual investors need to focus on is taking some profit off the table, perhaps shifting around some money from something that is done very, very well to something that perhaps hasn't done well as yet. I have two stocks here that I've been taking some profits off the table with. The first one, United Rentals. Now, some of you may not be familiar with United Rentals. I guarantee you've seen their trucks on the road here in Toronto or throughout the United States. United Rentals basically rents heavy machinery. Different than Caterpillar, which is more global. They sell heavy machinery. United Rentals predominantly North American, US, Canada, and they're more rental of heavy machinery, various heavy machinery, similar to even a Deere. And if you look at their chart here, how much the stock has run up over the past year or so, it's done phenomenally well. Earnings have been good. So this is a name that I've been starting to trim and take some profits off the table. The stock is still relatively well priced, so not too expensive. But I think with a name like this and the run that it's had, perhaps it's time to trim some of the profits and use that money to buy something else. Perhaps beef up something that hasn't moved higher as yet in your portfolio, in your current portfolio, or perhaps buy a new investment idea that right now looks cheap, has great earnings, and even pays you a bit of a dividend. United Rentals doesn't pay much of a dividend, so perhaps taking some profit here makes sense. Another name, Goldman Sachs. We have a graph of that as well. Goldman Sachs, as you can see, has had a run up in the last little while. The far right of the chart shows us that Goldman Sachs is near their highs. You know, it wasn't long ago where Goldman Sachs traded above 400. It's now about 361, but recently it hit as high as 375. And again, I started trimming back some of the profits and moving that money into other areas. So before you make your investment decisions over the next few weeks, I think you need to look at what in your portfolio makes sense to trim back or to sell off some of those profits to generate some cash, especially if you don't have cash available in the portfolio right now, that you can then use to buy other names. You know, if you're going to sell some Goldman, maybe you want to move that into the Bank of America, which has maybe a little bit more room to run. If you've made quite a bit of money in a name like NVIDIA, which we don't have a chart of, but that has done extremely well recently, maybe you move that money into a different chip maker. So I think right now, especially with the market running as high as it did, as fast as it did at the beginning of this year, January, beginning of February, we've seen a bit of a pullback now. It definitely makes sense to trim some of the profits and move some of that money into other areas of the market, of the economy, that you think has not come back yet, and that will rebound in the coming months. We always say you can never time markets. You can never time the market. It's not timing the markets, it's time in the market. So over the long term, you know, if you invest in good quality investments, those investments can pay you a dividend. That's how you watch your portfolio grow, your wealth grow. It's not by getting in and out. And the month of January was a clear example of this. If there ever was a month or a time period where you could see that timing the market wouldn't work, it was definitely January. And we have a chart of the S&P 500, the largest index in North America. And you could see here, coming into 2023, the market, as I mentioned earlier, the month of December was poor, and we were at a low point as we'd entered into 2023. So if you were someone that said, you know, Allan, I have some money, but I don't want to invest it right now. I want to wait till things get better before I invest. Famous words I hear quite often. And then, you know, I'm okay with missing out on the first bit of gains in the market and then get in later on. As you can see, it happened so fast, these gains in the month of January, that the stock market, the S&P 500, jumped 5-10% in a matter of weeks. And if you were somebody who held technology stocks, for example, you made even more than that as the NASDAQ jumped double digits. So if you were someone that perhaps was down 10-15% last year or 10-15% off your highs, stock market last year was down 20% overall. So being down 10-15 is actually not too bad for returns for last year. you could have easily made back half those losses in a matter of weeks. Yet if you tried to time the market, didn't want to get in until you saw things get better, you clearly would have missed out. So understand that timing markets and waiting to see the good times before you make an investment decision, yeah, it can work for the long term, perhaps. It's very difficult. It's difficult. You will miss out clearly, and you will get in perhaps at a wrong time. And if for some reason you would have gotten into the market, let's say last week or in the last maybe week and a half or so, trying again to time this market, we just saw a bit of a sell-off in the markets on the S&P 500 in the last week based on Federal Reserve speaking, higher interest rates, etc. So timing this market, especially a volatile market, where the VIX goes from 19 all the way up to 23, and then back from 23 down to 17. When you see the volatility as we have over the past year, it is very difficult to time markets, and something I don't recommend. Buy good quality, move your money around, trim some profits. That is a better strategy than moving all your money in and then all your money out, and then only to come back in when you think it's a good time. AI and ChatGPT. These are terms, words we've heard a lot of recently. AI, or artificial intelligence, has been around for a long, long time. You look at IBM and their Watson computer. These are terminology, or this is terminology that I've heard that is coming. Well, guess what? It's now here. And companies like Microsoft and Google recently have made a lot of investment in that space. And they've been the ones that are in the news the most. However, you could go to Amazon, you could go to Meta or Facebook, Apple, any of the big tech names, and they're all using artificial intelligence. It's going to revolutionize the way we do search, that we write our exams or essays, I should say, our blogs, a way we get information from the internet. It used to be a time where if you didn't know a piece of information, you'd go to the library. I remember as a student at University of Toronto, going to the library and researching a topic that I needed to write an essay on. Well, that was replaced by just Google it. If you don't know an answer, Google it. And Google will, based on a search through Google, you would pull up all the information that you needed. Well, now artificial intelligence, ChatGPT, is taking it one step further. It's giving search, in some cases, a personality. It's giving search the ability to not only find the information, put that information together in some sort of format, whether it's a blog, an essay, whatever you're looking for, give it a sense of humor, write it based on the level of a child or an adult or an expert in their field. It can do so many things. So here we are one step further again. It's, in my opinion, going to take the place of perhaps a few jobs down the road as artificial intelligence gets better and better. But overall, it's definitely starting to affect investors and the economy and the stock market. Let's take a look at a chart of Microsoft. We have one here. Microsoft recently made a huge investment into ChatGPT. They're trying to get artificial intelligence involved with their search, their Bing, as they call it, Bing search. And stock ran up tremendously. Was as high as $275 a share recently. And as you can see on the far right, has pulled back again based on higher interest rates, etc. But overall, this idea of this idea of artificial intelligence and involving artificial intelligence in Microsoft search. So being a competitor to Alphabet, many investors love that and took this stock higher. On the flip side, if we look at Alphabet, a chart of Alphabet, we can see that it hasn't had the same success. They came up with their, I think it's called Bard, if I'm not mistaken, which is their artificial intelligence. And you can see on the far right that Alphabet had their stock price fall dramatically, because once Microsoft announced that they were using artificial intelligence for search, everybody automatically looked to Google or looked to Alphabet and said, you know, what are you doing? And when they came out with their artificial intelligence, they hit some snags and unfortunately didn't work out as yet for them. But I believe artificial intelligence is going to be everywhere. And eventually Google stock or Alphabet stock will rebound from the recent low points that it's put in the low 90s. So I think going forward, artificial intelligence will make a big difference in technology, especially chip makers. I talked about NVIDIA multiple times on this show. I really like NVIDIA. They're going to report earnings tonight. It'll be very interesting to see what their involvement in AI is. They have the high-level chips, the chips that are powering artificial intelligence right now. AMD, their chips, and other chip makers out there that are involved in artificial intelligence. So this is an area, the semiconductors, that the area that was beat up the most last year is showing right now the most promise this year, and a lot of it has to do with artificial intelligence. Oil. Oil is something that has been so volatile. It moves based on geopolitics. It moves based on, in my opinion, manipulation. It moves based on what a few countries are saying and what they're doing. One of them being the United States. The United States produces the most energy or oil today, well over 11 million barrels a day. Saudis are obviously producing a lot, but they've cut back their production recently. The Russians are producing, but the Western world not buying from Russia right now, obviously, with the situation in the war in Ukraine. So overall, oil is something that I think can move higher, yet doesn't seem to want to move higher. We had a bit of a setback with oil with respect to the Chinese and China being closed, for their COVID restrictions. Those policies have now gone away, and now they're in the stage of reopening once again. They do have a lot of COVID cases, a lot of people still staying at home, but overall, they've been able to reopen. And we all think that this will be good for the price of oil. This will cause oil to move higher because we know China is the largest importer of energy or oil in the world today. So as they come back online, price of oil should move higher. Yet it hasn't as yet. Price of oil is somewhere in the mid 70s. And so anyone who's owned an oil stock as of late have seen their stock fall. I have a stock here called Pioneer Natural Resources. And I show this one in particular for two reasons. One, you could see that it is a major US producer of gas and oil, natural gas and oil. You can see the stock on the chart on the far right-hand side. The stock price has fallen quite a bit. However, I think, in my opinion, if you are going to make an investment in oil today, I think number one, you can, but number two, I think you want to buy the oil names that pay good dividends. And this name, Pioneer Natural Resources, pays a 12% dividend today. And I believe that dividend is secure for the time being. Obviously, if we see oil prices fall significantly from here, we'll have to take our cues from that and perhaps make a change. But overall, right now, there are a number of oil companies that pay good dividends. Pioneer, in my opinion, is one of the best. Devon Energy is another one in the US. Here in Canada, Suncor pays almost 5%. CNQ pays 4.5%. And if you want to move into the pipelines, TransCanada Pipeline or TRC Energy, they are paying close to 7% dividends right now. Enbridge, a name we all know, we all pay our Enbridge bill, 6.8% dividends. So you don't have to go necessarily south of the border to buy energy. You could buy energy here in our country, avoid the currency exchange, and still make good dividends. So that would be my strategy. So the answer to the question, can you buy oil stocks or oil investments today? In my opinion, I think you can. And the ones you want to own are those that are paying good dividends and where those dividends are secure and even increasing over time. We're exactly 1 week away from the RSP deadline so that your RSP contributions can be eligible to write them off against your 2022 income tax. So March 1st, 1 week today, is the deadline. And for all of you that are waiting to the last minute to get that T4 to see how much income you had last year to make that contribution, good news is you still have the next 7 days. I'm getting a lot of questions, as I often do. RSPs, should I make an RSP contribution? Should I put money into my tax-free savings account instead? And as I've said on this show, I think last show and a few shows before that, I think it all always comes down to, do you need a tax deduction or do you not need one? And so because the TFSAs now allow us to put up to $88,000 for the life of the plan into a TFSA, provided you were 18 years of age starting in 2009, then TFSAs are a viable option instead of an RRSP. RRSPs give you that tax deduction when you contribute to them, but when you pull money out later on, you have to pay income tax. TFSAs, you contribute to the TFSA, you do not get an RSP deduction, but that money grows inside a tax-free savings account and you don't have to pay any taxes on the gains. And when you pull that money out, you pay no income tax or any tax whatsoever. So a very powerful tool for individual investors. And as I said, husband and wife, $88,000 each, you're looking now at well over $170,000 that you can invest tax sheltered to grow tax sheltered. And when you pull out, tax free. So going forward, if you're thinking about an RSP, you're thinking about a TFSA, ideally, if you can do both, that's great. But if you have to make the decision whether it's one or the other, consider tax deduction versus not a tax deduction. Consider maybe longer term investment versus something you could have access to like your TFSA in the short term. And I think when you think of it in those ways, making an RSP contribution or a TFSA contribution, I think that will give some clarity as to which account you should contribute to over the next 7 days and going forward beyond that. Before we get to the last part of the show where I take some of your questions, I think I said TRC. It's actually TC Energy, TransCanada Energy. Used to be TransCanada Pipeline in Canada. They're the ones that are paying almost 7% dividends. So I just wanted to correct myself there. Now we get to the questions, your questions that you've had over the course of the show, or maybe emailed me during the last couple of weeks. Try to get to as many as I can. I think we can maybe get to 2 or 3 of them, as we often do. Is now a good time to invest in crypto? Do you invest in crypto for your clients? Great question. You know, crypto is something that we don't speak a lot about, especially as of late. Crypto or Bitcoin, let's talk about Bitcoin, hit as high as over 60,000 US dollars. Today, Bitcoin is somewhere around 24,000. What do I think about crypto? Well, my opinion of crypto hasn't really changed. It is a very high risk investment. And when you have an investment, or in this case, a currency or technology that right now is not being backed by anyone of significance, so a central bank or banks or countries, it's very difficult to get behind crypto right now. It's not being recognized, still not being recognized by government. You hear some of the biggest banks in the world, JP Morgan, Jamie Dimon, their CEO, speak about how it's just, it's nothing. It's just smoke and mirrors. You hear out of the Warren Buffett camp how crypto is just a fool's game and shouldn't be bought. So with all these major investors, major institutions, governments, the central banks, Federal Reserve, you name it, seems to be everyone is on the side of saying crypto is just, the technology behind it, which is blockchain, is good and will be used in many areas, but digital currency or cryptocurrency is just not something that they believe in. So very difficult to get behind. I do have some investors that own a little bit of it just for diversification purposes, very small amounts. If you want to buy a small amount for the speculative part of your portfolio, go right ahead. But understand that you'll have big swings and you could have big losses going forward. A second question I see here. Chip semiconductor stocks seem to have really picked up this year. Why do you think this has happened, and is it sustainable? So I touched a bit about on that when I spoke about NVIDIA. Semiconductors have had a run up. These are your chip makers. I think a lot of it has been on the back of these AI, artificial intelligence announcements. But overall, I think it's just simply because this was the area that was hit hardest last year. And I know that may not be, fundamentally sound to say or technically sound to say, but sometimes it just comes down to what was beaten up the most last year tends to be one of the better performers this year. We often talk like that about our Canadian banks. The bank that did the worst out of the 5 largest in Canada the year prior is usually the best performer the next year. And so I think individual investors came into 2023 when they looked around, they saw technology as the most being area to be sold off, and in particular, semiconductors or chip makers. And I think the money has flown into those areas, into those companies. And with the most recent announcements of artificial intelligence, things just continue to pick up. Lastly, let's hit one more question. I think we can squeeze it in. I have a number of Canadian stocks. I'm wondering about buying some US stocks, but the Canadian dollar has fallen a bit recently. Do I need to factor that into my thinking? The answer is yes. You always need to factor in currency whenever you use Canadian dollars to buy US, or US to buy Canadian, or Canadian to buy euro. Whatever it is you're buying, you always need to factor in currency. The good news is when you take Canadian to buy US, which I often do for my investors, usually the Canadian dollar hovers in that 75 to 80 cent range. Today, it's somewhere closer to 75 versus 80. About, in the last 12 months, about a year ago, it was probably closer to 80 than 75. So plus or minus 5%. So you definitely want to factor that in when you make your investment decisions. And you want to buy individual investments that can withstand perhaps a bit of a sell-off in currency while you own it and before you eventually sell it. So currency, yes, currency does play a factor when you buy individual investments outside of, the country that you're buying from. So Canadian dollars, if you're living in Canada, taking those dollars and buying US stocks. I think that's all the time we have for today's show. I want to thank all of you for tuning in again. We will be back on air with a new broadcast beginning of March 8th, Wednesday, March 8th at 12 noon. And until then, as I always like to say, happy investing.